Welcome to episode 1856, and we have Lynette Zang back with us today to talk about monetary policy, a little bit of fiscal policy maybe, but certainly gold and inflation hedging. And we are witnessing what is possibly a huge, huge shift in the economy. If you haven't been watching, notice, because times they are changing. But I notice that so many people just don't get it. They don't get it. They have their money invested in certain things. So let's say, for example, you or someone you know, your friend or family member, is invested in stocks, bonds, cryptocurrency, and they have seen a bloodbath, an absolute bloodbath. And we look at the housing market, we look at real estate investing, and we think, wow, it's the last man standing. Oh, actually, I should be more politically correct. It's the last person standing. Sorry, don't want to offend anybody. I know how sensitive we all are nowadays. Anyway, so the last person standing is real estate. And we have seen mortgage rates nearly double. But we've got to ask ourselves, compared to what, right? So let me see if I can grab a friend and get her to come on and join the intro portion of the show today before we get to Lynette. Hey, Tina, will you come over here? No? Why not? No, she doesn't want to be on camera. Why? Oh, bad hair day. Okay. Why? What's the issue? Oh, stressed out about the economy and everything that's going on? I understand. Okay, anyway, Tina does not want to come on camera because she's having a bad hair day. And she's having a bad hair day because of all of the craziness that's going on in the economy. But let's talk about her. We've talked about her before. Her name, T-I-N-A, Tina. What does it stand for? It stands for There Is No Alternative. And that's what I'm getting at. Tina is a fictitious person. She's not, well, I guess she's always here with us, all of us actually, but not in human form, right? We will just honor her because of the lesson that she teaches us. So we have our money invested in stocks, bonds, crypto, whatever, right? And we have experienced absolute devastation. It's been devastating. I mean, look at what is going on. The stock market is collapsing. The crypto market has already collapsed. What's next? Real estate is still chugging along pretty well in the face of all of these. As much as the Fed is trying to cool off the real estate market, it's still trucking. But how long can it continue? And the answer is, we don't know. Nobody really knows. But inventory is still extremely low. Even now, yes, it has been ticking up with these rate increases, but I mean, we still need triple to maybe 4.5 times the amount of housing inventory we have now to be at a normal market. To just be normal. Normal. That's it. That's all it gets us. That doesn't get us a recessionary real estate market. It doesn't get us a buyer's market. It doesn't get us a big downturn or collapse in prices. It just gets us to normal. That's all. So we have Tina here. Well, there's one other investment I want to talk to you about, and most people don't consider it an investment, but it has to be evaluated that way. And that is a bank account. If you have your money in cash, maybe you've got it in money market or savings account, checking accounts, whatever, right? Your money's in cash. You know for sure, officially, without any argument, that you are losing 8.5% annually. So you're losing money for sure just due to inflation. And if you have a little bit of an interest rate return on that money, you're paying tax on that interest rate, even though you're really underwater because the IRS doesn't understand inflation. They don't calculate it correctly. And hey, they don't want to calculate it correctly because it works to their benefit. Okay, so what does Tina tell us? It tells us we've got losing money in the bank, losing money in stocks, losing money in mutual funds, losing money in bonds, losing money in crypto. We got all of that. And then we've got real estate. We've got income property. And most people think the returns are just not good enough for them. Not good enough. Why do they think that? Well, because, hey, why should I buy a property with a 1% cash on cash return? But they don't know how to do the math. Because for sure, if they just keep that money on the sidelines in cash, they're losing 8.5%. And in reality, they're probably losing about 16, maybe 17%, the real inflation rate. I mean, can you imagine? You got $100,000 in the bank, and next year you'll only have $83,000. Yeah, it's pretty devastating. Pretty devastating. So if you put that money in income property and you know how to do the math, you'll earn probably on that deal I just mentioned, because Lisa, one of our investment counselors, did a pro forma on this the other day, and it showed a negative cash on cash return. But when you do the math and you consider the multidimensional benefits of real estate investing, leverage, equity buildup, depreciation tax benefit. Well, this didn't even include tax benefits, actually. I'd take that out. Okay, it didn't even include that. When you consider all of these things, you're making a positive return of 17%. And if you're losing 17% in cash in the bank, then your real return on investment is 34% annually. Okay, well, maybe you don't believe me that the inflation rate is 15 or 17%. Fine. Just take 8.5%. Take what the government tells you. Then you're losing 8.5%. Plus, on the income property, you're going to get another 17% in this example of not our best deal. Not at all our best deal, right? So what? You're looking at about 25% ROI. Where else can you get that? Tina, come here. What? Tell our listeners. Oh, she doesn't want to come on. It's a bad hair day because this economy is freaking her out. And, rightfully so. But folks, just learn how to do the math. If you're new to this stuff, understand that income property is a multidimensional asset class and you earn your return in many, many ways. Go to jasonhartman.com, watch that free video on the front page. Just get that free video right there. You take 30 minutes to understand the math, understand how to calculate return on a real estate deal, on an income property. Not real estate, I shouldn't call it that. It's income property. Learn how to do the math, and then you will see. And hey, we might have, none of us know, because how far is the Fed going to push it? I mean, they're about to do another rate hike, and they're trying their best to cool off the real estate market. But we still have a long way to go to get to equilibrium in terms of inventory. We are far away from that. Now, we might get there, but that's only going to be a normal market if inventory triples. If we have triple the supply, we'll have a normal market. And remember, when you segment by price and you look at entry-level housing, which is what we like to invest in, of course, in linear markets, the inventory is dramatically lower than the statistics. So no charts and graphs today, just a frank talk. It's like your parents sitting you down for a frank discussion. And that's what I'm doing here. Income property is the most historically proven asset class in the entire world, and it's the most tax-favored asset class in America. So hope that helps. Let's get to Lynette, part 2 today, and we'll go to that right now.